Welcome to this review and tutorial of the JBL Risk Manager. Now before we get started, as we do with all of our videos, we always have to put our disclaimer up there. And the idea behind the disclaimer is just to let you know that the video is designed to be an educational video, and any of the signals I'll be showing to you are strictly for demonstration purposes only. The JBL Risk Manager was created by a gentleman by the name of Joseph Barrington-Lew. That's of course where the JBL comes from. And this program will do a number of different things for you, including telling you exactly how to manage your account, what the correct position size or how many shares you should be trading at any one time, exactly where you should be getting out based on a number of different types of stops, and also help you analyze your overall portfolio. Did you know that more than 90% of new traders fail in the market within their first 90 days? Now this is a pretty scary statistic, and the question is, why is that number so high? And I think there's possibly a number of different reasons for this. Maybe a lot of new traders go into the market with bad strategies to begin with, or maybe it's just their lack of market understanding or a lack of capitalization. Well, I asked this question to Joseph, and what his response was is that in his opinion, a lot of times a new trader will hold on to a losing trade too long. And I think this is actually a pretty important concept, because if your trade is going bad and you don't have a clear understanding of knowing where or when you're going to be getting out of a trade, a lot of times it's just too late. And this is exactly where a program like the JBL Risk Manager will help you out. So the question then becomes well, how often do you really need to be right to be successful in the market? Do you need to be right 70%, 80%, 90% of the time? And I think to achieve these types of numbers would be extremely difficult, to say the least. So the good news to this question is, did you know that some of the best traders in the world aren't right more than 50% of the time? So then the next question is, if they're only right half the time, how in the world do they make enough money? And the answer to that question is not concentrating on how often that they're correct, but when they get out of a winning trade, it's how much they win, and when they get out of a losing trade, it's how much they lose. And to put that information into a usable calculation, you need to learn how to calculate what's called the trade expectancy. The trade expectancy takes your percentage of winning trades and you multiply them times your average win, and you subtract from that your percentage of losing trades and you multiply that times your average loss. So let's just say hypothetically that you have a trading strategy, but you're only right 40% of the time. But on those winning trades, you're making $600. So from that, you'd subtract your percentage of losing trades, which in this case would be 60%, and then you multiply that times your average loss. So again, let's say that hypothetically we're losing $200 on our losing trades. So if you calculate that out, that'll give you a trade expectancy of a positive $120. And learning how to calculate this and focus on this number rather than how many times you're right or wrong is much more important. And if your trade expectancy is a positive number, you're on the right track. So again, take a look at this example. If somebody presented a trading strategy and they said, well, my trading strategy is only right 40% of the time, would you be interested in that? And the answer to that is you need to look at some more information. And after you calculate the trade expectancy, and if it's a positive trade expectancy, that might be a very good system for you. And this, of course, is why it's so important to learn how to calculate this. So if you've got a trading strategy that's only right 40% of the time, you're going to have to learn how to deal with losses. And to help you with that type of mindset, let me suggest some goals. And that is, be the best loser that you can be. If the trade's going against you, be quick to get out of it. The quicker that you get out of a losing trade, the better off you'll be. You can move on to the next trade. And what you'll find is that if you learn how to take small losses, you'll learn that taking a loss isn't that big of a deal, and you can be much more objective about your trading. And then on the other side of the coin, let your winners run. And I'm sure a lot of you have heard this before, and that is, let your winners run, cut your losers short. But the question is, how do you really do that? I mean, it sounds good, but doing that in real life is obviously extremely difficult. And that's exactly where the JBL Risk Manager can help you out. Based on your account size, it'll tell you exactly how much you should be trading, where your stop should be placed, and of course, keep you on the right track. And once you learn how to work with the JBL Risk Manager, you'll be pleasantly surprised that there's really only two major rules inside the program. Rule number one, never risk more than 20% of capital on any one position. So let's say, for example, that you have a $20,000 account. If If you have a $20,000 account and you're not risking more than 20% of capital on any one position, that means that you can purchase up to $4,000 of one security at a time. And the second rule is never risk more than 2% of your capital on any one trade. So again, if you have a $20,000 account, that means the most that you're going to risk on any trade is $400. So think about this for just a second. If you have a $20,000 account and your biggest loss is $400, think how many losses you can possibly take before you really hurt your account. And by thinking of it in this terms, this of course is going to alleviate a lot of the stress that otherwise would come with your trading and allow you to look at your trading in a more objective light. So there's a couple of different types of money management strategies that are actually pretty popular. The first one is what's called the martingale money management strategy. And the martingale money management strategy is designed to have you trade more when you're losing. Now this particular strategy appeals more to the gambler. And the whole idea is that if you start losing, you're going to start increasing the size of your trades in the hopes that you get your account back all in one fell swoop. The problem with this is that if you have a number of losing trades back to back, this can damage your portfolio beyond repair. So in my opinion, if you're going to be trading the markets, using the martingale money management strategy is a horrible idea. Instead, what I'd recommend is what's called the anti-martingale money management strategy. And with this strategy, you're trading less when you're losing and you're trading more when you're winning. And this is designed to take advantage of those winning trades and cut your losses short. So let me give you a couple different examples here. This first example I'm going to show you here is using no money management at all. This is taken out of a book called Universal Principles of Successful Trading. And this black line that we're looking at here through the middle of our chart is the equity that was gained through this trading account. And for this particular example, he traded the Japanese yen. There were 326 total trades. He started off with an initial equity of $20,000, a margin set at $4,000, and a maximum number of contracts at 100. And looking at this black line here, you can see again that your equity started off at a value of 0. And during this period of time, at the very end of the graph, you can see that it's worth over $250,000. And as you can see, this is extremely impressive. I mean, obviously this was a very good trading strategy and it worked very well. But while this is really impressive, take a look at using the exact same strategy using what's called the anti-martingale money management system, using a fixed percentage for your losses. So in this example, he started off with an initial equity of $30,000, the margin at $4,000, fixed percentage risk at 2%, and a maximum number of contracts at 100. Again, he's using the Japanese yen for the trading vehicle. There were 326 total trades placed, and you'll see that the equity curve actually looks similar, but the big difference is that after those 326 trades, the account grew to almost $20 million. Now that's obviously a huge difference. Now while this is of course hypothetical, the point being is that if you use correct money management in your trading account, it can make a huge difference for you. And the JBL Risk Manager uses the anti-martingale fixed percentage method. So let's take a look at it. So when you install the JBL Risk Manager, you'll notice that your screen is divided up into three major sections. The section up at the top is for your open trades. The section in the middle is for your closed trades. And the section at the bottom has to do with your account and how much money you have in your account and your overall settings. So let's go ahead and set up an account. To get started, I'll click on this Create New / Load Portfolio button. And to get started, I'll go ahead and just give it a name of JBL Demo. I'll click on the Create New Portfolio button. And now you'll see that I've got this loaded down here in the lower left-hand corner. Next, I'll click on the Settings button. And this will allow us to control the settings that the program's going to use. This is divided up into four major areas. The top section has to do with your trailing and profit stops. The section in the middle is for your money management. The section at the bottom has to do with where your data is going to be coming from. And the section over here on the right has to do with the commissions that you're going to be charged from your brokerage. So first of all, what you want to do is you want to choose your default exchange. Click on this drop down arrow and you'll see that the program is set up to handle a number of different types of currencies throughout the world. So in this case, I'm here in the US, so I'm going to choose the US NYSE, or the New York Stock Exchange. And when you select your exchange, you'll see that the currency symbol down here will be updated to reflect the correct currency. Now up at the top of our screen, this has to do with our trailing and profit stops, and we can control these two different stops from this window here. Now the first one is what's called the trailing stop. A trailing stop is designed to follow your prices, and that is, if you're buying a security and the price is moving upward, a trailing stop will follow those prices and get you out at a more profitable position. If you're selling a security short and the prices are dropping, the trailing stop will follow the prices down in the hopes that it'll get you out at a lower price. Now to calculate a trailing stop, it can be done in a number of different ways, but the JBL Risk Manager uses an indicator called an ATR, or an average true range. And the advantage of using an average true range indicator to calculate the trailing stop is it incorporates volatility. And the nice thing about incorporating volatility is, based on how much your security is moving around, this trailing stop will be adjusted. So for example, if you're buying a security and the price is moving up, but it's a very volatile security, meaning that it's moving around a lot, the trailing stop based off the ATR might be a little bit wider, allowing that security to move a little bit more. And the settings for the ATR or the trailing stop can vary depending on the type of trading that you're interested in. If you're a short-term trader and you only hold a trade for a few days, you might be interested in selecting the short term. If you're more of a swing trader and you hold a trade anywhere from days to weeks, you'll probably want to choose the medium term. And if you're a position trader and hold trades for maybe months, you might want to consider using the long term. And then based on which setting you select, the ATR will then be adjusted. So what I'll just choose the medium term. So choosing the medium term, you'll see that the multiplier is set at 2 and my ATR is set at 8 periods. Now there's a second stop inside this window called the stop percentage. Remember when I said before that the second rule inside the JBL Risk Manager is never risk more than 2% of your account on any one trade? Well, that's set right down here in this window. You'll see that the default is 2% risk per trade. So we're never going to risk more than 2% of our capital on any one trade. Well, what this stop percentage level means is that if the trade moves against you, in this case more than 9%, but you're not at the 2% of your total capital account, this setting will kick you out of the trade. So it's just another way to get out of the trade if things are moving against you. And what's also nice inside of this dialog here is that all of these numbers can be adjusted. So if you feel that you want to use some other numbers other than the default, you can just click on them and change them to whatever you'd like. Now over here on the right hand side, this has to do with your commissions that you're going to be charged by your brokerage. You'll see the default is set at $9.95 here in the US. So what I'll do for simplicity is I'm going to change that to an even $10. So in this case, I'll get charged $10 for a long trade, and then I'll do the same thing for the short trades as well. And you'll also know that inside of this particular dialog here, you can also change it to a percentage as well based on the size of your trades. So again, just adjust it to whatever you're charged from your brokerage. Now over here on the left hand side, this has to do with where your data is coming from. Now if you have data that's saved or stored on your hard drive, you can tell the program where it should be getting its updates from. Just click on the Add Directory button down here at the bottom and then select where your data files are located on your hard drive. But what's really nice inside of version 9 of the JBL Risk Manager is you now have the capability of getting a free internet price data update. And this makes things much easier to work with, in my opinion. And to select the internet price data, just put a check mark in this box, and you'll note that you'll get a message here stating that it is free internet data, and what's highly recommended is that you double check the prices before ever placing a trade with your broker. So once you have your screen set up the way that you want it, down here at the bottom, just click on your Save Settings button. Next, I'll click on the next button over called the Manage Capital. This will allow me to put some money in the account. So what I'll do up here at the date is I'll simulate that I've started this account here in 2014, because what I'm going to do is I'm going to show you some historical trades for examples. I'll say that the account that we're going to set up is funded with $20,000. I'll click on Deposit, and now you'll see that that information is updated down here in the lower left hand corner. Next, let's take a look at a possible trade. For this first example, I've got a chart of Boeing, And the template that I have applied to it is a trading strategy called the RMO. It's an extremely popular trading method. And the idea with this method, if you're buying a security or going long, you're looking for the oscillator to be positive, you're looking for blue colored price bars, and you're looking for upward pointing blue arrows. So let's say hypothetically that this is a strategy that I'm using here on this particular security, and we want to simulate that we bought this security back here at the beginning of 2015. And we'll see how the JBL Risk Manager would help us manage a trade. So first of all, let me go ahead and zoom in here a little bit on our data. So I'm going to highlight this section of our chart. And I'll pick a pretty good trade. Let's say that we are following this security here, and we got a buy signal, it looks like here on January 9th, 2015. So if we got a buy signal here on the 9th, let's say we got in on the next trading day, which in this case would be January 12th. So to simulate that trade, the first thing you'll do inside your JBL Risk Manager is you'll click on the New Trade button down here at the bottom. Next, click on the symbol box right here, and we're going to enter the symbol for Boeing. So underneath the security box, I'll just type in the symbol of BA. I'll hit my enter key, and you'll see that it'll do a quick lookup. And from here, I'll select the correct company that I want. So it's the third one down. I've got it highlighted, and then I'll click on the OK button. Next, you'll see that the buy date field is then highlighted. So I'll go ahead and click on that. And what we're going to do is we're going to simulate that we bought this back in January of 2015, and the date is going to be January 12th. I'll go ahead and select that and click on OK, and that'll put in our information. Now since we're going back and we're simulating a hypothetical trade, you'll see that the information is filled out from January 12th going forward. So let's take a look at some of the information that we have populated here on our screen. So as you can see here from this dialog, the opening price on January 12th is 132.24. So let's say hypothetically that we got into the trade at that price. So I'll adjust the buy price here. I'll change that to 132.24. And then you'll see that there's a quantity box. You'll see the recommended buy quantity is 28 shares. So I'll take the recommendation and I'll put 28 inside the quantity box and hit my enter key. And when you do that, you'll see that things will be updated here for you, telling you exactly how to manage this particular trade. You'll see that over here on the right hand side, you can see that the total that was spent on this particular trade. And then down here at the bottom of the window, you'll see that inside this box right here, it shows that our maximum risk that we're going to be willing to take is 2%, which is a maximum risk dollar amount of $400, and the risk per share equates to a little over 14 points. Now this box over here on the right hand side called the break even, this is a fourth type of stop that the program also uses. And the way that the break even is calculated, it says that if your trade doesn't hit the break even point within 10 days, it would recommend that you get out of the trade. And the reason being, of course, is that if you're not at least breaking even within the 10 days, your money's probably better spent somewhere else. So let's take a closer look here at this first line right here. You'll see that we have January 12th, we have our open, high, low, and close, our ATR moving average, our stop loss, percentage stop, and so forth. Now the current stop that if we were simulating that we bought this on January 12th would be set at the numbers underneath this current stop column. So in this case it'd be 118.67. And this number is coming from this column here called the stop loss. In order for the percentage stop or the ATR stop to be used as a stop for your trade, your securities price has to trade better than the break even within the 10 days. So your initial stop is set at 118.67, your break even is 132.95. And if you look at the closes over here, you'll see that it finally closed above the 132.95 on January 21st. And for that reason, it looks like your stop then changed to the ATR stop. You'll see that the program will use the most profitable stop, meaning that it's going to attempt to get you out of the trade with the most profits. So in this case, your stop would have then been moved to 131.58. And you'll see that the stop remained at this level until January 28th. So I'll go ahead and scroll down here a little bit. And the reason being is that ATR stop was bumped up to 137.01. So on a daily basis, this is what you'd be doing, is you'd be taking a look at this information, seeing where the prices are and where your stop should be placed. And also what's nice inside this dialog is down here at the very bottom, you also have a little diary here, and you can make some notes about your current trade. So let's say, for example, that I bought this security based on an RMO signal. Okay? And to save your trade, just click on the Save Trade button down here in the lower right hand corner. And now you'll see that this trade is now stored or saved underneath your Open Trade section. And to open it up, just double click on it and you'll be right back inside that same dialog. So again, on a daily basis, we're monitoring our trade, and what we're looking for here is we're taking a look at where our current stop should be set. And as we kind of scroll down here through time here, you'll see that we finally got an exit here on February 25th. And the reason why we got an exit on February 25th is because our stop was set at 153.71. And you'll see that the close on the previous day was 154.38, and then it traded to 153.01. And for that reason, the program is recommending that we get out of the trade. So let's say that we took this recommendation and we got out at the opening of the next trading day. So in this case, we'd get out at February 26 at 152.31. So to exit out of the trade, down here at the bottom, just click on the sell date field. This will open up your calendar, and I'll scroll back here to February 26. I'll select that and click on OK. And then down here underneath the sell price, we'll say that we got out at the opening on the 26th of 152.31. So I'll go ahead and enter that in. And then I'll click on the Save Trade button down here at the bottom. And now you'll see that our trade has been moved to the Closed Trade section. So what's interesting about using a money management program to help you manage your trade is that once you enter in the information, you're no longer really looking at the chart trying to determine where you should get out based off the chart patterns. The risk manager is now telling you where to get out based off of the share price itself. So in this case, for example, we got a buy signal here back on January 9th, so we got into the trade on January 12th. And the JBL Risk Manager told us to stay in that trade all the way up until this bar right here, which was February 25th. And so we got out on the 26th, which was one day before this particular sell signal. So again, this is where it gets really tricky for a lot of traders and using technical analysis, is determining exactly where to get out of your trade. And using the JBL Risk Manager, it takes all that emotion out of it and tells you where you should get out based on prices only. Let's go ahead and enter in another trade. This time we'll do a short trade. So let me go back here in time a little bit. And this time let's take a look at a sell signal. So here's a pretty good sell signal. This one looks like it happened here on October 1st of 2014. So let's say hypothetically that we went short on the next trading day, which in this case would be October 2nd. So to get started, again, we'll click on the New Trade button down here at the bottom. And since we're going to be going short this time, put a check mark in your short trade box. Click on your symbol box. I'll go ahead and type in the symbol of BA and hit my Enter key. I'll select the Boeing company from my choices here and click on OK. Now for the date, I'll go ahead and click on this box, and I'll scroll back in time to October 2nd. There we go. I'll choose October 2nd and click on OK. So now let's simulate that we got short at the opening on October 2nd at 124.40. So I'll adjust my sell price here to 124.40. And you'll see the recommended quantity is 31. So I'll go ahead and take that recommendation. I'll enter 31 and I'll hit my Enter key. Again, everything's been updated here for me. So based off this information, if I got in at 124.40, you can see that the current stop that it'd be recommending is 138.30. You can see down here at the bottom that my maximum risk dollar has gone up a little bit because we had a winning trade, increasing the size of our portfolio on the last one. So again, down here at the bottom, I'll go ahead and make a note about this trade. I'll say selling BA short based on an RMO sell signal. Okay, once you're happy with it, click on the Save Trade, and that again will save your trade underneath the Open Trade section. To open it up, just double click on it. And on a daily basis, we'll be looking at the prices and where our stop should be set. Our initial stop is set at 138.30, and you can see that the break even is set at 123.75. If you look at the closing prices here, you'll see that on the 6th, the price was at 126.26, and on the 7th, it closed at 123.32, and for that reason, we traded through our break-even level, and now you can see we're using the ATR stop as the most profitable stop. So in this case, on the 7th, our new stop is set at 126.77. And as the prices are moving downward, you'll see that our stop is now adjusting downward to get us out at a more profitable price. And as we kind of scroll down here a little bit, you'll see that on October 17th, it looks like it generated an exit signal. And the exit signal was generated because our price or our stop was set at 120.69. And if you look over here on the 16th, you'll see that the price closed at 120.29. But then on the 17th, the price has moved up to 123.24. And since our stop was set at 120.69, it's recommending that we get out of the position. So let's say that we took this recommendation and we got out at the next opportunity. So in this case, it looks like we get out on October 20th. And again, let's assume that we got out at the opening of 123.39. So underneath the buy date field right here, I'll go ahead and select that. And I'll scroll back in time here to October 20th. I'll click on OK. And on October 20th, the price was 123.39. And you'll see that our quantity was set at 31. And we'll say that we bought back all 31 shares. And from here, I'll click on the Save Trade button. And again, our trade has been now moved down to the Close Trade section. Now once you've closed out a few trades, then you've got some more information down here to help you out. You'll see I've got 2 total closed trades. I have 1 long trade and I have 1 short trade. And then through here, it'll give you all the statistics on those trades and how they worked out. And what's really nice about that is that this will also calculate your trade expectancies for you as well. The first one will calculate your trade expectancy based on all the trades, and then it'll break it out based on this case on long trades and also short trades. Another nice benchmark is down here at the very bottom. You have a portfolio comparison. If you click on this compare button, you can compare your portfolio against, for example, like an index. So let's say, for example, that I want to compare this to the S&P 500 over the same period of time. Underneath the security button, I'll just enter in the symbol. And the symbol for the S&P 500 is GSPC. Go ahead and hit my enter key. And I'll go ahead and select it. And then click on OK. And then down here at the very bottom, you'll see that I've got my symbol, GSPC. And during that period of time, for example, in this case, my first trade was placed on October 2nd. You'll see that the S&P 500 is up 9.09%. During that same period of time, our trading account increased $593 for an increase of 2.97%. And then comparing our account against the S&P 500, you can see that it underperformed the S&P 500 by a little over 6%. Included with the JBL Risk Manager are a couple calculators that I think you'll find of interest as well. To open them up, click on the Settings button down here at the bottom, and from here you're going to click on this button called the Display RTC. RTC is an abbreviation for the Risk Tolerance Calculator, and using this calculator will help you understand how trading losses will affect your account. So to use it, up here at the top here, just go ahead and put in a starting capital. So in this case, I'll use my $20,000. And then underneath the brokerage, enter in the commissions that you get charged. So for example, I get charged $10 each way. And then underneath the max risk percent, these are the percentage levels that you can take a look at. So the default max risk percentage that JBL recommends is 2%. So I'll use that and hit my enter key. Now what this is showing us is that, again, we're starting off with a $20,000 account. And this column over here on the left hand side are the number of consecutive losing trades. So for our first trade, if we're risking 2% of our total capital, that means our total loss would be $400. and that works out to $20 in brokerage fees and $380 in trading losses. And if we lost $400, that means our account would now be worth $19,600, meaning we'd have 98% of our account left, and we'd have lost 2%. After 2 trading losses in a row, our account now would be down to $19,208, and after 3 trading losses, our account would be down to $18,800, and so forth. And if I scroll down here a little bit, you'll see that after 20 consecutive trading losses, our account would then be down to $13,352, meaning that we have 66.7% of our account left, and we would have lost 33.2%. So the point to this is that if you're risking 2% of your account and you went through a horrible streak of 20 trading losses in a row, you'd still have almost 67% of your account left. And just for comparison purposes, if you're taking on a little bit more risk, and even if it's not a whole heck of a lot more, let's say for example that we're now risking 5% instead of 2%. I hit my enter key and you can see what the differences are. On my first trade, for example, if I lose 5% of my account, that means my first loss is $1,000. And after 20 consecutive losses, my account now would be down to $7,000, meaning I'd only have 35% of my account left. And hopefully this makes it a little clearer of exactly why you need to manage those losses. And also up here at the top, there's another box here called the enter percent loss. And you can enter in any number that you want up here, but what this is showing that based on how much you lost of your account, how much you would need in order to get back in order to just recover what you started with. So in other words, if you lost 64% of your account, you'd have to get 179% return in order to just get your account back to where you started. And this is again why it's so important that you manage these losses. If you can keep these losses small, then hopefully you can recover fairly quickly. But if the losses get too big, it'll be extremely difficult to recover from. Also down here at the very bottom of our screen is another calculator which is called the compound growth calculator. And this is kind of interesting too, because what this will allow you to do is allow you to ask what if questions like how would my money grow based off of different percentage returns. So again, let's say for example that we've got a $20,000 account and we say we got a growth rate of say 2%. And based off of a 2% growth rate, you can see how the account did. Now these numbers over here underneath the after column are the number of periods. So after one period, and a period can be a day, a week, a month, or a year, but after one period, if you start off with a $20,000 account and you're achieving 2%, your account would then be worth $20,400. After 2 periods, you'd have $20,800. After 3 periods, you'd have $21,224, and so forth. So after 12 periods of 2% growth, your account would now be worth $25,000, and your total return on your account would be over 26, almost 27%. And if you want to compare it to a higher percentage rate, over here on the right hand side, just enter in that number and hit your enter key, and you can see how those percentages would work out as well. But again, looking over here on the left hand side, if we were able to achieve a 2% growth rate over every period, and again, let's just say that these are representing months, after 12 months your account would be up almost 27%. And a 27% return on your portfolio would be excellent. A lot of money managers would kill to have that type of return. So the point being is that you don't have to hit it out of the park every time. If you can achieve a modest growth rate and do it consistently, it can really add up over a longer period of time. Also, there's another calculator that's been added in version 9 as well, and this calculator will help you determine what prices might be based off of Fibonacci projections. Now Fibonacci is actually a pretty complex subject, but let me give you a quick explanation. The basic idea in calculating a Fibonacci extension is that you identify the low point of a securities move and a high point of a securities move, and then based on the overall trend, the Fibonacci projection using that low and high will help calculate where the prices might go based off of certain percentage levels. So let's just say hypothetically that we're in an upward move or an upward trend. if the low of the recent move was, let's say for example, like 50, and the high of the most recent move is set at 54, if you type those numbers in and hit your enter key, this will give you what's called the retracement level and the extension levels. The idea is that if the price moved from 50 to 54, based off of a 38% retracement, the price would be at 52.47. Based off of a 50% retracement, the price would be at 52, and based off of a 61.8% retracement, the price would be at 51.53. And then after the prices retrace and then move upward, these are the different prices that the security could move up to based off of these different percentage levels. And then let's say for example that if you're in a downward trend, and let's say that the high was $54 and the low was at 50, and based off of the Fibonacci retracement and projection, the prices have moved down, they hit a low of 50, they retraced up, and then based off this retracement, these are the different prices that they would be at these different percentage levels. And then if they continued in the downward move, these are the different prices that they would be at these different percentage levels. And again, this is a pretty complex subject, but if you're familiar with Fibonacci's and how they work, this can be a very useful calculator for you. And if you're ready to get started with the JBL Risk Manager, please go to jblriskmanager.com/learn Metastock. And from there you can either do a 14-day free trial of the program or you can purchase it outright. And if you have any questions, please don't hesitate to let us know.